U.S. stock futures just slipped as Iran rejected the peace offer, and CSL cut its profit outlook. This volatility can trigger FOMO, or the fear of missing out, in investors. According to a study by the Journal of Behavioral Finance, 60% of investors experience FOMO, leading to impulsive decisions. So, what is FOMO? It's the anxiety or apprehension that one is missing out on a potentially profitable investment or opportunity. Research by Kahneman found that people feel losses 2x more intensely than gains, making FOMO a powerful driver of investment decisions. Imagine you're at the grocery store, and you see a sign that says limited time offer on your favorite product. This scarcity tactic can trigger FOMO, making you feel like you need to buy it now. In investing, similar tactics can lead to impulsive decisions, such as buying into a hot stock without doing research. So, how can we overcome FOMO in investing? One strategy is to set clear financial goals and stick to a long-term plan. A study by Fidelity found that investors who had a written investment plan were more likely to stay on track and avoid impulsive decisions. Another strategy is to practice mindfulness and self-reflection. By being more aware of our thoughts and emotions, we can recognize when FOMO is driving our investment decisions and take a step back. According to a study by the Harvard Business Review, mindfulness can improve investment decision-making by reducing emotional reactivity. Neuroscience research has shown that FOMO is associated with increased activity in the brain's reward system, particularly the nucleus accumbens. This can lead to a rush of dopamine, making us feel good in the short term, but potentially harming our long-term investment goals. A study by the Journal of Consumer Research found that social media can exacerbate FOMO, particularly when it comes to investing. Seeing others' investment successes can create a sense of FOMO, leading to impulsive decisions. It's essential to be aware of these social influences and take a step back before making investment decisions. To avoid FOMO, it's crucial to stay informed but not obsessed with market news. A study by the Financial Industry Regulatory Authority found that investors who checked their portfolios less frequently were less likely to experience FOMO and make impulsive decisions. Practicing gratitude can also help alleviate FOMO. By focusing on what we already have, rather than what we might be missing out on, we can cultivate a more positive and resilient mindset. According to a study by the Journal of Positive Psychology, practicing gratitude can increase well-being and life satisfaction. FOMO can also lead to the sunk cost fallacy, where we throw good money after bad because we don't want to admit our initial investment was a mistake. A study by the Journal of Behavioral Finance found that investors who fell victim to the sunk cost fallacy experienced significant losses. The fear of missing out can also lead to herding behavior, where we follow the crowd and invest in a particular asset because everyone else is doing it. According to a study by the Journal of Financial Economics, herding behavior can lead to market bubbles and crashes. To avoid herding behavior, it's essential to do our own research and not rely on social proof. A study by the Financial Industry Regulatory Authority found that investors who conducted their own research were more likely to make informed investment decisions. Mindful investing can also help us avoid FOMO by focusing on the present moment and our long-term goals. According to a study by the Harvard Business Review, mindful investing can lead to better investment decisions and increased investor satisfaction. The media can also contribute to FOMO by creating a sense of urgency and scarcity around investment opportunities. A study by the Journal of Financial Economics found that media coverage can influence investor behavior and lead to market volatility. FOMO can also lead to overtrading, where we buy and sell investments too frequently, resulting in increased fees and decreased returns. According to a study by the Journal of Behavioral Finance, overtrading can lead to significant losses and decreased investor satisfaction. To avoid overtrading, it's essential to set clear investment goals and stick to a long-term plan. A study by Fidelity found that investors who had a written investment plan were more likely to avoid overtrading and achieve their investment objectives. Practicing self-compassion can also help alleviate FOMO by treating ourselves with kindness and understanding when we make investment mistakes. According to a study by the Journal of Positive Psychology, self-compassion can increase well-being and life satisfaction. FOMO can also lead to confirmation bias, where we seek out information that confirms our investment decisions and ignore information that contradicts them. A study by the Journal of Behavioral Finance found that confirmation bias can lead to significant losses and decreased investor satisfaction. To avoid confirmation bias, it's essential to seek out diverse perspectives and consider alternative viewpoints. According to a study by the Journal of Financial Economics, seeking out diverse perspectives can lead to better investment decisions and increased investor satisfaction. Today, take one action to overcome FOMO: write down your investment goals and create a long-term plan. By doing so, you'll be better equipped to avoid impulsive decisions and achieve your investment objectives. Remember, investing is a marathon, not a sprint.